Welcome to Chapter 4, Agency and Stakeholders. The first area that we're going to look at is really the link between agency and government. What we'll be doing within this video is sort of exploring the sort of issues associated with having a principal and an agent, and indeed how governance attempts to sort of support and indeed augment that relationship and make sure that it works properly. So in terms of the first area here, let's just take a look at what governance is. We should know from our studies that really we're talking about essentially the way in which businesses are directed and controlled. The system, sometimes referred to as managed and controlled. In essence, what we're trying to do with corporate governance is to make sure that we avoid some of the problems that we've seen over the last 20 to 30 years. I'm talking, of course, about corporate failures. I've just given you two examples. We don't need to know the details of them, but if you Google corporate governance failures for corporate failures, you're going to see over the last 30 years or thereabouts, since the beginnings of corporate governance, certainly in the UK in the early 90s, just a ream, a plethora, a multitude of entities that have been badly run. And indeed, more often than not, it's individuals such as directors, chairmen, CEOs, CFOs, etc., who are responsible for the runnings of those companies and indeed the problems that they get themselves into. So what is this agency problem? As you can see here, we're talking about really the relationship between the people that manage and control the organization and indeed the owners. They're unlikely to be the same, even in sort of some small, certainly medium-sized and large listed entities. Clearly, we're talking about the separation of ownership and control. As businesses have got bigger, shareholders and owners need people to run them. So there's your problem. Outside of that, some key buzzwords in this first section. Given what we've just said already, clearly accountability is important. In other words, the accountability of the managers or directors to the owners, or indeed, if you will, the accountability of the agent, the directors, to the principal, the shareholders. What does fiduciary duty mean? Well, really, broadly speaking, a sort of a duty of care in a financial sense. If you imagine that, in effect, a director or indeed a manager is akin to a sort of a steward, a steward on a ship. You have to, or you have been asked to, as it will, you don't have to, guard the assets, guard the business, guard the future of the business. That's a key duty. Let's remember these buzzwords as I point them out to you from time to time. Outside of that, now, theory itself, agency theory, really what we're talking about is really the negatives. Certainly there are duties, but broadly speaking, agency theory is about the problems and indeed the conflicts that occur between parties who have a relationship. In this case, and invariably within the SBL exam, we're talking about the agent and the principal, the directors and the owners or shareholders. Series of definitions here for you. We just touched on this. Clearly, you have individuals, managers, directors, they're hired. They're employed. They don't own the business. They may own shares, but broadly speaking, as an employee, their job is to act in the best interest of their employer, i.e. the principal, and indeed to carry out tasks on the principal's behalf, not on their own behalf. Agency simply means just the relationship between the two. This little area here is interesting. Costs. Let's make sure we have a fix on this. This is useful in exam questions. We're talking about the costs in indeed establishing in the first instance and indeed monitoring the agent by the principal. Principals or owners or shareholders aren't simply going to appoint managers and directors and just walk away. There are costs associated with keeping an eye on them. Outside of that, last one here, residual loss. So really what we're talking about there is not a loss in the normal sense, but really the idea that, individual directors or managers may in fact, rightly or wrongly, or in the full knowledge of principals, shareholders and owners, award themselves salaries that are sort of beyond basic salaries. So I guess in one sense, it's the price that principals or owners pay for having to employ people to run businesses. I mean, company cars, houses, planes, club members, these aren't unusual, but certainly I think if you asked principals or agents or owners or shareholders, would you like to lower the cost? They would certainly say yes, they would. So this is the residual loss. This is the loss that really owners and principals can't avoid. The next area for us is really the whole area of the problem itself. And given what we said up top, I think we're aware of it. I mean, looking back on incorporation and businesses becoming incorporated some 150, 160 years ago, you will have had ownership and control because many businesses were fledgling, small, run by freelance individuals, a family, etc., etc. But over the course of time, as businesses grew, as industries grew and markets grew, ownership became separated from control. Businesses were too large for the owner to be involved in the control. So we had, obviously, incorporation. You may be familiar with the concept of the veil of incorporation, the idea that an entity is set up and it's separate from the owners. And really, the managers are there or the directors are there to assist in the running. So we have different owners to controllers. So unfortunately, human nature would suggest that you may well have divergent interests or different interests. Now, in terms of the problem, well, in essence, if you think about it, that shareholders are looking for a return, aren't they? In other words, owners need a return. They want shareholder wealth maximization. What does that mean? Well, they want a dividend return and they want capital growth. And indeed, directors and managers are responsible for providing that. But often we find that directors, unfortunately, perhaps have their own interests at heart, not shareholder wealth maximization. What would be an example of that? Well, focusing perhaps on the short term, maybe a short-term bonus, as opposed to the long-term benefit of shareholders and indeed shareholder wealth maximization. So that's the problem. Some examples. High salaries, let's say over and above the norm. Golden parachutes, in other words, really awards to managers and directors should the company get taken over. And these golden parachutes would be built into employment contracts. In other words, directors would argue openly for the inclusion of such clauses, but they cost money. And indeed, if you think about it, on occasion, perhaps more than 50% of the time, more than 80% of the time, takeovers by another party, maybe that's a great idea for shareholders. But, directors and managers may not think like that. These are costly. Next one, poison pills. Well, poison pills are really a sort of a clause, or indeed a term, that's sort of written into contractual arrangements, let's say shareholders agreements, or indeed employment contracts, whereby if a company is bought out or taken over, let's say by a hostile group, then in effect something clicks in within an employment contract or possibly a shareholders agreement or the articles of association that makes it very, very difficult for the takeover to take place. Now let's think about it. Is that necessarily in the best interests of shareholders who may be in for a big return or a big payday? Possibly not. Now note that these are just examples. It doesn't mean that a poison pill is completely out of order. It doesn't mean that a golden parachute is completely out of order. We're just giving you examples. Last one here, perhaps more obvious, non-business use of corporate assets, whatever they are. A bit of a no-no. Okay, let's move on from there. Agency costs. Now, I mentioned this up top. We have a relationship between two different parties. There must be costs of sort of maintaining that relationship. There must be costs associated with the principal or the owner monitoring or keeping an eye on, if you will, the managers and directors, and indeed there are. So three main types. Monitoring costs. Okay, so for example, audit fees. I mean, audit fees can be very, very large. What's the purpose of them? Well, to make sure that financial statements show a true and fair view, but certainly to keep an eye on the company assets, to keep an eye on the people running the business. Outside of that, certainly NEDs wouldn't need to exist if we trusted all directors. NEDs exist in an overseeing role. They need to be independent. They are certainly monitors of the business on behalf of shareholders or indeed the principal, if you will. Next one, bonding stroke contracting costs. So really what we're talking about here is the costs involved on behalf of the agent in the production of information really for the principal. So for example, the production of the financial statements, that's an expensive exercise. How does that help? Well, it helps the shareholder to know the results of the business, the return on their input, the return on their shareholding. Outside of that, this is pretty common, stock options. This is a cost involved in contracts with highly qualified, sought-after directors. If you don't pay them, these directors go elsewhere. Last one, residual costs. So really what we're talking about here is not so much something that is necessarily completely over the top, but really the cost that individual principals have to pay to engage with good quality, experienced, expert directors and managers. They can't do anything about it. They need to build in things like incentive schemes into contracts. That's it. End of story. They have to do it. Next area for us is, given what we've said, there's an issue between those that, generally speaking, manage and indeed direct and run businesses, and indeed the owners, the principal. We see that there's a possibility of divergent interests, and we see that there are costs associated with monitoring and indeed overseeing that role. We see that corporate governance is really in play to assist shareholders and indeed regulatory bodies, etc., in sort of making sure that directors and managers are watched. That's the purpose. The purpose is to control the controllers. So, what else can we do? What can we do to sort of align the two interests? Now, quite a few examples here. This isn't anything or everything and anything. First one, incentive schemes. Let's try to encourage or indeed motivate directors to act in the right way. Let's provide them with incentives. Outside of that, this is very much on the part of the owners or shareholders. Get involved. Get involved in AGMs. Don't simply buy your shares and not have some sort of active participation in the running of the business. It's not difficult to do. The more involved you are, the more you see what's going on. Number 3, board composition. Certainly, shareholders have the right to appoint or indeed veto or indeed remove individuals from the board if they feel that an individual director is not doing what they want them to do. In other words, not aligned with shareholders' interest or shareholder wealth maximization, they can get rid of them. Resolutions. Certainly resolutions are a possibility, probably not overly popular with incumbent directors, but what we're talking about here is really a certain proportion of shareholders resolving to do X, Y, Z. Now, a certain requirement, it depends on the articles of association, etc., and shareholders' arrangements and agreements. But shareholders can band together to really put forward different resolutions. Number 5 here, sort of, I guess, worst case scenario, if you're unhappy with the way in which directors and managers are operating the business, you can certainly sell your shareholdings. But that surely would be sort of, the last resort. Really, ideally, you want a group of directors, a group of managers who are running the business properly. You shouldn't have to sell your shareholdings. Last one, communication, one-to-one meetings, keeping in touch. Not dissimilar, I guess, to number 2 in terms of being actively involved in the business, in annual general meetings, etc. Okay, so these are some suggestions. Okay, now do remember throughout these mind maps that, we don't need to memorize or learn everything, but just get a feel for the basics. Okay, what's the problem? What is the agency problem? Why does it exist? Why does corporate governance exist? Outside of that, what can be done? And indeed, why does it need to be done? What is it about directors that causes the problem? Etc., etc. Okay? Moving on from here, next area for us, stakeholders. Now, this is certainly linked to the above because outside of shareholders, there are many other entities, groups, individuals who are important to a business. So what's the definition of stakeholder? So we're talking really about groups or individuals either can affect or be affected by the organization in some way, shape, or form. And we'll see later on within this particular mind map that there are many ways in which stakeholders can be managed. And indeed, outside of that, these groups or individuals, not all of them will have the sort of same status, the same power, or the same interest. Okay? Moving on from there, linking in stakeholders to agency now. So broadly speaking, we've got 2 theories. The first one is the theory really that we've been discussing. The idea that in terms of directors and indeed managers of business, agency theory would suggest that that's the most important relationship. And in fact, it's one way, isn't it? In other words, it's the relationship between directors and managers and owners, or if you will, between the agent and the principal. Okay? So that's agency theory. What's the other theory? Well, the other theory brings in really stakeholders. And what we're saying there, they're not quite diametrically opposed. But stakeholder theory suggests that, okay, clearly there is an important relationship between directors, managers, and indeed shareholders or owners. But there are a myriad of other important relationships. So, for example, between directors and employees, between directors and customers, between employees and customers. So stakeholder theory would suggest that directors have really more than a one-way relationship. They have a multitude of different relationships with different stakeholders in the business. And really, they're all important to a lesser or more degree. And we'll see a little bit later on, as I've said, the whole idea of stakeholder management. Now, in terms of how the above affects the boardroom. In other words, given the fact that we have several theories, agency versus stakeholder, we know that that whole agency problem is a common problem and causes issues between the need and the requirement for shareholder wealth maximization and indeed directors and managers pursuing their own interests. What could happen? What should happen in the boardroom? Well, first things first, communication, dialogue, and engagement. You need to have open modes of communication between all parties, and in particular between directors and indeed shareholders, or between the agent and indeed the principal. Outside of that, one thing that's important here is that in terms of dialogue and indeed engagement with all parties, empirical studies going back to the 1990s have proven that good comms with all stakeholder groups on behalf of directors and managers generally, not always, but generally tends to lead to better performance and better results. So the better the dialogue is, the better the engagement is, the better the communication is, businesses become more successful. And this is based on empirical studies worldwide. Now, next key area here is really bringing everything together above. Donaldson and Preston came up with sort of 2 concepts or approaches, if you will, Now, we've already touched on these, but we haven't touched on the buzzwords. The first one, instrumental approach. Now, remember, we are in the stakeholder section here. So what does this mean, instrumental approach? Well, really, what this means is that the bottom line for directors and indeed managers is that in essence, instrumental, the stakeholders aren't overly relevant. This is what the instrumental approach says. At the end of the day, communicating with them is just a means to an end. Okay, so to some extent, the instrumental approach sort of lacks a sort of element of morals. Yeah, let's communicate with stakeholders, shareholders, because we have to. It's a means to an end. Now, the alternative approach is what's called as normative. And you might sort of suggest it's sort of more normal. What this approach says, as you can see, is, well, no. The idea that we interact, engage, and communicate with stakeholders, all stakeholder groups, is because we're a decent bunch of people. We've got some morals. We like to act in an ethical way. It's not just about getting what we want. It's not just a means to an end. So here, morals are important. So let's try and remember that. Remember that within SBL, we don't need to really know the names of all the theorists, but knowing buzzwords, for example, instrumental approach or normative stroke intrinsic, this is helpful. And if we litter or pepper our scripts here and there with buzzwords, we're going to pick up marks, okay? It will impress the marker, okay? Next area, this is quite short, really. This area just suggests or reminds us of risk. Now, we know risk is an important topic area for us, certainly within this particular syllabus, but it just reminds us that, of course, with corporate governance, there are risks all over the place. And we've touched on a few up top, the risk that directors will act in their own interests, the risk that, there may well be a fraud of some kind, the risk that we don't maximize shareholder wealth. So in terms of two key risks, now let's remember that business risk is sort of, I guess, the broad heading. That is the risk that business will not achieve its objectives. A business, generally speaking, a for-profit business, exists to achieve its overall objectives. I mean, obviously, shareholder wealth maximization is right up there at the top, but it does that by pursuing its objectives and expanding into this area, launching a new product, going into a new market, etc., etc. So business risk is right at the top. Outside of that, stakeholder risk is really the idea, given the section that we're in now, is really that directors or owners, or indeed, I guess, just a business, will not be able to maximize wealth because they don't engage with stakeholders. They don't understand how important that is, or how important, having relations or relationships with that myriad of stakeholders, how crucial that is. That is stakeholder risk, okay? Now, we talked about sort of management, didn't we? We talked about the idea that stakeholders need to be managed. First things first, before we look at Mendelow's mapping grid, I know that you will be familiar with that for sure. Obviously it's based on the first two areas here, power and indeed interest. In terms of power, we're talking about their strength. Do they have any clout? Can they influence us, and how much so? In terms of interest, are they bothered? Do they care about what we're doing right just now? Do they care about this strategic move? And indeed, I guess the combination of both of them is broad influence. So Mendelow's grid is based on these areas. We're talking about power on the left and indeed interest at the bottom. And we know what Mendelow says is, really, you've got four main choices here in this set of quadrants. Now, in terms of the first area, let's deal with this one first. Minimal effort. So we're talking about low power, low interest. Now, more often than not in this era, I would put sort of low-level employees. With respect, perhaps people on the shop floor, individuals that are more interested in getting their wages on a week-to-week basis than the overall strategic direction of the business. So what do we do? Well, minimal effort, really. Minimal effort. Outside of that, if we move to the right-hand side here, we see really in this area, we see high interest and indeed low power. So really these individuals, not unlike minimal effort, really don't have too much power to do anything at all. In other words, we can broadly, as directors or perhaps owners, etc., we can sort of go in the direction we want. But these individuals are interested. So you might be talking here perhaps about low to middle level management, other staff, perhaps run-of-the-mill suppliers, etc., etc. So what do we do with them? Let's keep them informed. They do have a high interest. They're interested in what we're doing, so let's keep them informed. But really, we don't have to pay too much priority to them because they are low power. Top left, we're talking about high power but low interest. Now, a word of caution here. The groups that I would be including in here always, but sometimes students don't, are groups like government, regulators, lobby groups, etc. We're really talking about groups that, as long as we don't step over the line as a business, as an entity, as long as we don't break the law, as long as we don't increase our carbon emissions or breach important regulations or legislation, the bottom line is that these individuals are not overly interested. They have low interest. But if we do overstep the mark, they have high power to make trouble for us. So what we do not want is, we don't want this keep satisfied group shifting to the right into key players. More of them in a minute. So in essence, what I find the issue with students is that they tend to put really many of the sort of stakeholders that you would sense have certainly high power, they automatically assume that they're highly interested. Governments, regulators, legislation, etc., they don't have the time to monitor all businesses on a daily, weekly, monthly basis. They only do so, they only get involved when businesses overstep the mark. Now, key point in relation to key players, these are our priorities. Who would be in there? Customers, more than likely. Certainly the board of directors, perhaps institutional investors and shareholders, other shareholders, particularly with listed companies. These are the stakeholders that we need to keep happy at all times. They are high power and high interest. Now, note that one important point about using Mendelow's matrix is to be careful, and this could be tested in a question, is that we could plot for any particular business all of their stakeholders in one of these quadrants. You can't be in two, yeah? But stakeholders' positions can change. So be careful that, if you're writing out answers to questions, that you never say, well, once they're in this group, that's it forever. No, it's not. Businesses, companies will be concerned, for example, as I've just mentioned, of stakeholders moving from keep satisfied to key players. Really, the less number we have in key players, the better, and indeed most likely in keep satisfied. But certainly this area, we're not overly concerned with respect, with minimal effort, or indeed with keep informed. So just remember that. Stakeholders can move. We prefer them not to. We want to know where they are. So moving on from here now, that is, I guess, your go-to stakeholder management grid. Mendelow talks about prioritization and provides advice, as we've seen, in each of the quadrants as to what we need to do. Let's move on now to roles. Now, here we're going to sort of pigeonhole different types of stakeholders. There's sort of different groups. Let me explain what I mean. The first area is internal. Okay, these stakeholders are internal to the business. What does that mean? Let's define it. Okay, we're talking about individuals or groups directly or financially involved in the organization. And as you'll see here, really, the two main types there are clearly employees, including directors. They're directly involved on a minute by minute, on a day by day, week by week basis in the running of the business. They're inside the business. Outside of that, connected stakeholders. Now, what do we mean by that? Let's look at the definition. Note an indirect rather than direct financial stake in the organization. And they're certainly, because they're stakeholders, affected by the organization's operations. What about types here? Well, quite a number. Clearly, shareholders are indirectly, in effect, connected because they will have absolutely share certificates, shareholding agreements. Customers are connected. Most likely, they may well have contracts, written agreements. Suppliers are the same, and indeed creditors are the same. So we're talking about an indirect financial connection rather than a direct, like employees and indeed directors. What about external? What do we mean by that? Well, we're talking about no direct or indeed indirect financial stake in the organization, but they're certainly influenced or affected by the operations. They would be. They're stakeholders. What about types here? Well, quite a number. Clearly, trade unions are interested in organizations. They're interested in the staff and the employees of the organization, but they don't have a direct or indirect financial interest. External auditors, in one sense, yes, they're employed by the shareholders to produce an audit report, to indeed check the accounts, but strictly speaking, they're outside the business. And invariably, that audit will take place perhaps once a year over several months. Regulators the same, and remember what I said about regulators and governments in terms of Mendelow's matrix. In terms of day-to-day, week-to-week, month-to-month involvement, very, very minimal. For most businesses, it's about compliance. It's about filing return, filing paperwork, making sure that you stay within regulations, within legislation, within the law. Once you overstep, that's when they become interested. Next area is corporate social responsibility. This is important because CSR is a popular topic in case study exams. Absolutely. Make sure that you're on top of this area, and I would include areas such as ethics and indeed sustainability. They're very, very easy areas for the examiner to write tasks and requirements about for any business. That's why they tend to come up. It really marks for very little. Now, in terms of the definition here, I've simply cut and pasted this from the Study Hub. Quite a mouthful, really. I like a more simple definition than what you see in the Study Hub. Obviously, the Study Hub, it's excellent, but they're trying to give you as much information as possible. My definition of corporate social responsibility is pretty simple. It's the idea that businesses should maximize the positive effect of their operations and their organization on society and the environment and minimize the negative effect. Okay, one more time. CSR, maximize the positive effect on society and the environment and minimize the negative effect. So what sort of areas would be relevant to that? If we have businesses that are very, environment friendly, operate in a very ethical way. So what sort of areas are we talking about? Well, we're talking about a number of different areas. For example, treatment of all stakeholders, treat them fairly. Treat them well. These are stakeholders. These are individuals that can affect or can be affected by the business. So treat them well. Be fair. The environment. The environment has become more and more important to everybody, not just businesses, not just for-profit entities, to everyone. Your approach as a business to the environment says a lot about you. Outside of that, interactions with local communities, whatever that is, perhaps it's a school, perhaps it's some sort of group, perhaps, we're looking at maybe sponsorship of a football team, etc., etc. And in all of the above areas, let's show as a business, let's show that we are transparent. What does that mean? Well, that we're open. we've nothing to hide. Let's also show integrity. What does that mean? Honesty. So really, transparency and integrity underpin these areas and really should ideally underpin everything that a 21st century organization does. Moving on from there, let's take a quick look at sort of, typical activities. So let's just say, that we have a business that is clearly pro CSR, recognizes its responsibility to society and the environment, and wants to maximize the positive impact. Well, for example, corporate philanthropy. So what does that mean? It means donations. It means charitable donations. And look at Bill Gates, look at Microsoft, look at Jeff Bezos at Amazon. You'll see that certainly donations and charitable donations are high on their list, for good reason. These are solid businesses. They want to help communities. They want to help the environment. Sponsorship, I've just mentioned up top, the idea that you would sponsor individuals that perhaps don't have the cash or financial resources to do things. It might be a football team. It could be something else. Outside of that, reporting. Now, we know how important and how prevalent a sort of narrative reporting, or if you will, integrated reporting has become in the last 10 or 15 years. Why not report on what you do in a social sense, i.e. in terms of your interaction with people, or the business's interaction with people, or the interaction with stakeholder groups, and also in relation to the environment. This is linked into, I guess, the origins of integrated reporting. Now remember, as a hot topic within the SBL exam, integrated reporting should be right up there. That would always be probably in my top 15 or 20 topics, be on top of integrated reporting. And indeed, outside of that, recognize how important it is for businesses to communicate what they're doing in a social sense and environmental sense. Linked into that, I guess, eco-efficiency, again, become more and more popular and more important for our planet. Remember the 3 Ps, people, planet, profit. They're all important. So with eco-efficiency, we're talking, for example, about a business really focusing on perhaps its carbon emissions. And we know across the board and indeed across the world, many or indeed most governments now have some sort of target in terms of zero emissions that's coming up pretty soon. From anything from sort of 2025 to 2030 and 2040. 5 to 10 years ago, those targets were out at 2040, 2050. Now they've come in. Okay, so eco-efficiency, e.g. emissions, this is an important area. Now, in terms of CSR viewpoints, Gray, Owen, and Adams have put together a number of different possible, if you will, stances. In other words, let's just say that you took 100 businesses, okay, and you interviewed them. Many of them would have different stances for different reasons. Everybody's different. Every business is different. So Gray, Owens, and Adams, you'll see from the study, I've actually come up, I believe, with 7. I've just taken a sample of 4. I think when we get these sort of long lists, the chances of any particular area, any particular stance, being targeted on its own is slimish as possible. So again, I refer you to my comment earlier on about rote learning every single thing you see in the study. I don't think that's needed. So in these mind maps, I picked out maybe 3 or 4 out of 7 or 2 or 3 out of 5, etc., etc. The first one here is quite straightforward. Pristine capitalists. Remember, we're talking here about a view on CSR. Now, what pristine capitalists really focus on, or indeed, if you will, given the word capitalist, their priority is shareholder wealth maximization. What's an alternative view to that? Well, expedience. What they say, unlike the above, is, okay, yeah, shareholder wealth is important, but we need to spend some money on corporate social responsibility. We need to recognize it because, at the end of the day, we know that businesses that are really, really pro-CSR tend to outperform ones that are not. So expedience really recognize the need, yes, for wealth maximization, but also say, listen, let's consider CSR. Let's put some money in this direction. Outside of that, social contract. Now, that's pretty simple to explain, as you see. Really, what social contract practitioners would say is that a business, broadly speaking, should act in an acceptable or a socially acceptable way. In other words, a business should really do the right thing. You know, you're allowed to run your business, but you exist in a society where there are other businesses and the public and individuals. So, you know, if you break that contract, you shouldn't be allowed to run your business. So that's the social contract. Last one here, I picked a little bit unusual, radical feminist. Now, readjustment required. Now, what radical feminists say is that really society and business, we need to change, because societal structures really allow for masculinity. In other words, aggression. The idea that businesses should compete like cats and dogs, and that in itself, according to radical feminists, is not good for the world. It's not good for business. Really, what we need is more nurturing. We need more feminine qualities. We need more compassion, etc., etc. So again, some of these are quite unusual. You may or may not agree with any of the four that I've just mentioned. But the bottom line is we're just talking about some suggestions on key approaches as per Gray, Owens, and Adams. Okay, more theory now. Now, there are a number of different models of CSR. When I say models, I'm talking about sort of, areas put forward by eminent theorists. This is just one by Carroll, the CSR pyramid. Okay. Now, this sort of ties in to some extent on what we've been talking about already. Let me explain what I mean. What Carroll and indeed his colleague Buchholz suggest is that in terms of your responsibility as a business, you've got a number of choices. You could just really pursue your economic responsibilities right down at the bottom. Now, what does that mean? What that means is that a business simply really pays its staff, okay, and pays its suppliers. It simply does what it has to do on an economic level just to exist. Now, note, it's not interested in law, because law or legal is the next phase up. So if you think about it, a business that really only considers its economic or stroke financial responsibility is a business that isn't even considering regulation or law. Really, the minimum requirement for a business is to consider its legal responsibility and to be at this level in the CSR period. I mean, in one sense, really, there's not too much corporate social responsibility going on here at all. This is just your economic responsibility. I'm going to pay my staff this month, and I'm going to pay my suppliers and myself. That's it. I'm not doing anything else. Here, you're doing that, but you're also abiding with all laws. So really, the legal level, level 2, that's the minimum requirement for any business. If you're down here, there's an issue. Now, where would you like to be, or where should businesses be ideally? Well, they should really be here. Because what this means is that the business not only recognizes its economic responsibility to pay staff, supplies, etc., also its legal responsibilities to comply and abide with laws, but also the need to act in the right way. To know the difference between right and wrong, to treat staff fairly, to treat all stakeholders fairly. Fourth level, right at the top. Now, this might be seen as sort of heaven, or indeed nirvana, philanthropic. This is where all three below are dealt with. But over and above that, the business really is making charitable donations, perhaps significant donations or a significant proportion of its profits, to various needy causes, children in need elsewhere, the homeless, etc., the local community. So philanthropic is all about paying cash out, paying from your bank account, and paying to the less advantaged in the form of charitable donations. Okay? Let's move on to our next area here. This is linked and similar to what I've just said, but this is generally referred to as stances or indeed ethical stances. Now, certainly, we've seen so far, there's a fair crossover, isn't there, between corporate social responsibility and ethics. They're sort of intertwined in one day. It's sort of difficult to separate them. But what do we mean here? Let's try and separate them. Well, what we mean is that, in essence, being an ethical business, being an ethical group of directors, managers, and shareholders, really what we should be doing is exceeding the minimum obligation to stakeholders. We should be going over and above that. We should be being fair, not just abiding by the law, not just paying people, okay? Now, Johnson and Scholes provide us with some nice buzzwords here. Now, these are important, in the same way that the CSR model above was important. Remember what I've said several times now. We don't need to do everything in the mind map, but understanding and memorizing some of these key buzzwords and trying to build them into their answers, your marker is going to spot them. Okay, so here's some important ones. So what do Johnson and Scholes say? They say, okay, a business has several possible approaches. The first one is that they sort of think in the short term, and they call that laissez-faire. Now, what does that mean? Well, Johnson and Scholes suggest that simply means that from an ethical perspective, the business is just thinking about short-term profits. That's it. They're just interested, they're not overly interested in prioritizing ethics or ethical behavior. They're thinking about money in the short term. Not great. Next area, enlightened self-interest. Now, this is very similar to the short term, but it suggests that the business is slightly more savvy in terms of the need to show some sort of interest in acting ethically for the long term, and indeed for their own long-term benefit. So really, number one and number two, not so good really, because they're broadly speaking very, very similar. One's about short-term gain, short-term profits, and one is about long-term gain, long-term profits. This is really where we should be at. Multiple obligations, sometimes referred to as multiple stakeholder obligations. So in an ideal world, all businesses would create that forum for stakeholder interaction and would recognize that as businesses that operate in the environment, in society, they have a responsibility and indeed an obligation to all stakeholders who are connected with that business. Last one, a little bit like the above when we had, sorry, let me just go back one second. A little bit like the above in terms of the CSR model, where right at the top we had philanthropic. This idea of shaper of society under the banner of Johnson and Scholes is really sort of heaven in one sense. It's really nirvana. What a shaper of society is in effect saying is, well, profits aren't important. Society is important. Looking after stakeholders is our first priority. Now, realistically speaking, that sounds great, but, I don't think a lot of businesses would put themselves under this banner. And I think if they did, then, it could cause issues. The bottom line is that shareholders require a return. So I think really the area of number three, and recognizing certainly that profits are important, but that all stakeholders are important, is probably where we need to be. The idea that we put everything else before profit, a la shapers of the society, is a little bit unusual. Okay? Now, next key area, again, this is linked, is citizenship. Now, again, all of these areas are linked, and this term really simply means, as we'll see in the first branch here, that really a corporation sort of is an individual in one sense. And individuals in society, and indeed individuals, let's say, that run their own businesses, they have rights, in other words, the right to run their business, but they also have responsibilities. So responsibility to society. So really what corporate citizenship means is let's treat businesses, corporations, whether or not they're for profit or not for profit, let's treat them as individuals and indeed understand, yes, they have rights to run their business as best they can, obviously within the law, but they also have responsibilities to society. This area is quite interesting. Before I had actually accessed the study hub, I hadn't heard of the Boston College Center for Corporate Citizenship, but they provide some interesting, quite useful advice. What they say is, let me just go back one second. What they say is, ideally, a corporate citizen or a good corporate citizen minimizes harm to everyone and anyone and the environment, maximizes the benefit to the environment. Remember our definition of CSR: maximize positive, minimize negative. Outside of that, accountable and indeed responsive to stakeholders. Remember we said engagement, participation, and listening. And indeed, outside of that, quite important, I thought this was an interesting one that they included, support strong financial results. And what the Boston College are saying there is shareholders deserve returns. So it's not just all about society minimizing harm and benefit and other stakeholders, but you've got to produce results for shareholders. They are the owners. They have bought shares in the entity. So you have to produce strong financial results. Okay? Last area for us really is something that, bear with me one second, something that we are going to see in a lot more detail later on in the course, and that's this area of sustainability. Now, the UN have set forward or put forward development goals in this area for indeed all businesses. The UN have done a number of amazing things. I'm not going to cover sustainability in detail right now because it's covered in depth later on in the course. For the moment, let's just remember that outside of the UN's actions and intentions and great objectives, sustainability is simply about preserving the world's resources. I mean, let's think about it. The world's natural resources are depleting, have been depleted. We need to preserve them for our children and our children's children, and indeed future generations. So all the SDGs is an attempt really to put forward reasonable goals for businesses and indeed for entities and for governments in this area. So more of that later on in the course. Okay, so that really concludes Chapter 4, Agency and indeed Stakeholders. I hope that you found that helpful. You may use the PDF mind map. You may use your own notes. Either way, get a grip on the key buzzwords. And as I always say within all courses and certainly SBL, let's practice. Let's practice questions. There are a number on the study portal and a number available to you. And let's try and use these buzzwords, okay? This is certainly a popular topic area in the SBL exam. Okay, thank you for listening.